Hello everyone, and thank you once again for joining Expose Friday live at 5, where myself and Ben Richards run through the highs and lows, challenges and successes in the multitude of businesses that we run, which is a measured surveying company. Ben runs his own architectural practice, a development company and a property investment business. This week we have some really fun topics to be discussing. There'll be a lot of detail shared on these topics, so please stay tuned. But most importantly, we're doing these for your guys' benefit, so please do ask questions. Put them in the questions wherever you are. If you're on YouTube or Facebook, they will come through to us. So just to run through the agenda, we had a up valuation or a massive valuation, which is quite unique. Anyone in our industries know that that's quite an anomaly. And then that moves us on to a massive down valuation. We had a valuation that went the other way, which tends to be more common, and we'll explain a little bit more why that might be and what we are facing and how we are handling it. Cash flow for projects. Do you ever ask yourself the question, if I'm buying this site, how much cash or investment do I need to do it end-to-end with bank finance? So it's all about deposits, purchase costs, and enough cash to deliver the scheme end-to-end. Getting your CGIs right. We use CGIs quite frequently on our projects, and it enables you to do multiple things to ensure that you can have quicker sales, and also good for marketing. So Ben will be sharing a bit more about that shortly. Delayed completion. Again, I think this is the third time we've pushed back at this completion of this site, and we'll be sharing why we would choose to do that in the situation we're in. Fire regulations and their impact. Ben will be sharing the exciting stuff with fire regulations, but equally and probably mostly more important, speeding up your development finance and what you might need to do that. We know that time costs money, especially when you're on development finance. So that's quite a key topic that we believe is strong. The charity Kayak, which we're going to be doing a week tomorrow. So for you guys that haven't seen the posts, go look at our pages, but we'll be talking about that later. We've onboarded a new mentee. So Ben and myself sat together with a new mentee, and we ran through their business plan, worked the 10 years forwards, then back to understand where we need to go. At the end, we always have a Q&A, but just before the end, we'll be sharing a property that we exchanged on today and what that looks like. And last but not least, for you guys that are listening on the podcast, the date is the 1st of September. And without further ado, I think we will crack on.
Yep.
Starting with...
Hello, everyone. We have got our massive valuation. For those that have been following us, you're probably sick of seeing this deal because we do shove it in people's faces a lot, but there's good reason for that. It's the deal that won Property Deal of the Year at the 2022 Property Investor Awards. It's called St Helens Mill, and it is in a lovely market town called Abingdon-on-Thames, about 10 minutes south of Oxford. And we had the formal RICS valuation back today for the refinance. And we've heard a lot of down valuations, and we're going to be talking about that next. And we've heard that the market is in a very, very tricky space, and people can't really peg where things are going to be coming in at. So we were super, super delighted to get the valuation that we received on this property. I'm going to enlarge the screen so that you can see more of it. Hopefully you can see those figures. But we bought the site for, just do a full screen, bought the site for 1.55 million, including all costs. This was actually a share purchase. So we bought the company that owns the asset as opposed to buying the asset itself. And that's something for another topic entirely. If you're interested in learning more about that, the pros and cons, then comment below. The build costs overall came in just over £400,000, and that's broadly accurate, isn't it? We've just almost finished the work now, and the budget.
I think we've got another 10k to spend on final refurb.
Cool. So about 415 in totalish. Professional fees about £15,000. This was a derelict. This was a block of 14 flats that had been in the same family for about 50 years. It was the conversion of a former mill house, and it was converted into 14 flats a long time ago. Hugely undermarketed, and really was more of an asset play. We see a lot of developers looking for brand new shiny deals where they want to build ground up and go through a lot of headaches of new build land developments and planning permissions. And this wasn't any of that. It was already income generating. We had to shift around a couple of the tenants to refurbish flats one by one. We did get planning approval to add 5 dormers in the roof and convert from a 2-bedroom flat into a 4-bedroom HMO, and that's literally being finished off as we speak. But there was no ground up development. There was no huge full planning plays that was very controversial and risky and time consuming. This was very much kind of almost an individual refurb done 14 times, just on a much bigger scale. And with that bigger scale gives, better economies of cost. And we've taken the asset effectively from the £2 million spend to where we expected it to come in at was just over £3 million in terms of the value. And you'll see on the screen there, the GDV we expected with the income over the past 18 months since we've purchased it was about £3.2 million. Now, spoiler alert, the valuation that came in yesterday was actually for an asset value of £3.4 million. So including the rental income that we've had, the total value of the asset to us over the last 18 months is just shy of £3.6 million, which is absolutely huge. When you look at that and a profit on GDV perspective as a percentage, we already expected it to be very good, i.e. 34% on GDV once all finance and costs have been accounted for. But the actual percentage profit on GDV for this scheme was 39.3%, and that is a RICS Red Book valuation after the fact. And we are, super excited to have got that over the line and added so much value to us and our investors. Do you want to say anything else, Jack?
No, nothing in particular. We haven't mentioned that if you're new, this project actually won 2 awards. We won Deal of the Year at the Property Investor Awards in 2022, and we also picked up Deal of the Year in the Developers Club as well. But it just goes to show, Ben and I always talk about ego building. Are you building for numbers or are you building for ego? And the numbers don't lie on this one. It's not the sexiest. It's not the most drastic development. Everyone thinks development's about walking on a greenfield site that's just grass and digging holes with high-vis hats. This has been a very straightforward de-risk project that we've really enjoyed, evidently by the numbers, but also reflecting back on the low risk. Because when we bought this site, there was a lot of speculation in the market around COVID and build costs and where the market was going, and the fact that our interest costs for the mortgage to do the development was actually equal to the rent roll. So it's fairly de-risked from that perspective.
Yeah, actually, last thing that I didn't say is that everyone's out there for the no money down deals. Are they out there? Can you find them? I don't believe there is such a thing as a no money down, but there is certainly a deal such as this, which is a no money left in. So on refinance of this asset, the £500,000 that was invested at day one will be relinquished, and we can use that to further fund other projects. And there's circa £1.2 million of equity baked into that asset that we now own, and it's kicking out about £190,000 a year in gross rental. So stonking deal, super happy. And if we could find more like this, we would be very happy. On to worse news.
Yeah, it's not
all roses.
Well, not all sunny skies and roses. Yeah. So with the highs also comes with the lows. So in short, this is a scheme that you can see in front, and pretty much 95% of our valuations that we get carried out are lower than our expectations or lower than what we're aiming for, and that is very common. This particular valuation is we bought the site already with a short-term lender, like a bridge, almost like a bridging product, and we're refinancing it out now. It has consent to convert it to 20 apartments on a new development facility. So the same lender that we bought the site with sent the same surveyors back to value the site. And where we've fallen short on this valuation is the actual gross development value, bricks and mortar valuation wasn't too far off. I think we were about 5% off where our expectations were. Where it really did fall short, and it's actually the first that we've experienced this, is the surveyor wanted to see a new build premium removed from the gross development value. So, the bank wanted to see the surveyor's opinion on that. And in short, when you collaborated the existing 5% down valuation, and the new build premium off that GDV, we're about 17% amiss from the valuation that we expected. We tried battling it. We pulled heads together and wrote a pretty accurate, astute, data-backed, comparable-backed, agency-backed, and broker-backed email, but it didn't work, in short. We don't know whether the lender's just trying to wriggle out of being in this deal. We think it's their loan to value is really low, and their loan to value ongoing will also be low for a very straightforward conversion. So it's just a shame we got to the point where we are now, and we're now, to overcome this, we are resorted to go back to market, new valuation, new lender, which we received terms for this week, and we've instructed valuation to go ahead. So I don't know if anyone else has ever seen that on the down valuation. I've heard of all sorts of horror stories, nil valuations for subsidence properties, nil valuations with no kitchens and bathrooms, but this one is a new build premium. And just to sort of explain why we argued that, is Abingdon is a market town with a lot of historic buildings, and quite a lot of people want the historic buildings and feel and sturdy structures that are already there. So this building is exactly that. It was originally a malting house for the brewery, and then it got converted to offices, and now we're converting it into residential. A lot of the brand new build stock isn't deemed as aspiring, but also most equally, new build stock can't be built right in the town centre because it's already being developed. So commonly, new build in Abingdon doesn't have a premium over something that's second-hand stock or new build flats in the town centre. So we strongly disagree with that. We challenged it, didn't really get anywhere. Comically, we actually sent an email out this morning doing the same on a different deal. I kind of feel our life is trying to talk surveyors and lenders around. But what you've got to remember is you're pretty much always expected to get a valuation lower than what you propose. So what we tend to do is ensure that our GDV values are optimistic and our build costs are realistic. Because if you go in a realistic GDV, they're only going to chip you on that value. The reason you might be asking yourself why is because valuers err on more on the side of caution. They're the they're the insurance or the dependency that the bank are looking for to value the building for their money, so that they do take a very cautious approach.
Yeah, very frustrating. When you've spent 5 to 6 grand on a valuation report that you've paid for on behalf of the bank, and it goes against your favor and there's no real logic put behind it. One of the most frustrating things is that I spoke to the RICS valuer on the phone, who said to me over the phone, it's nonsensical what they're asking for. It's not really a standard way of us valuing an asset, but it's what they've asked for, and I'm not changing my mind. It's even more frustrating because kind of the guy's agreeing with me and us, but is unwilling to rewrite the report because it's essentially backed by their PI. He would never write that in an email. He would only ever say that to me over the phone. So it's just hugely frustrating. We're back to square one. We've now got even shorter time frame to get this refinance over the line with a new lender, which has already started. So that's the type of stuff that we have to deal with. If you are new to the development game, welcome. This is what you should expect.
Cool. So next topic is, what cash do you need to do your development? And this is a very, very common byproduct of valuations. If you get a down valuation or your build costs are more priced in as more than you thought originally, what you might then be struggling with is the balance of what the bank are prepared to give you and what you've got to put in as your investment. We always have a buffer, and this is just a bit of a cheat sheet on how we start to guide what sort of monies we need in. To estimate what sort of cash flow we need to deliver a project from end to end. Before we get into what this is made up with, we use a rule of thumb for conversions and buildings, existing buildings, that you tend to average about 50% of the purchase price in cash to do the deal. So the bank tend to lend you 70 to 75 or 65% of the purchase price, and then 100% of the build costs. But what we've learned is you tend to need around 50% of the purchase price. We are down south, so anyone up north, that might differ, and land definitely does differ because land values are lower, and what the banks are going to be cautious of and the things that they really care about is loan to value and loan to cost and loan to gross development value. So that 50%, we tend to sit just above all of their thresholds for loan to value, loan to cost and loan to gross development value. They sort of have a rule that if you hit any one of those rules, they have to restructure the debt. So it's really important that you make sure that you set out with the right amount of cash flow. One thing that you can do is we use this 50% rule of thumb just to get the deal secured under offer and work out our finance costs. Once that's done, get to a lender or a broker to get an agreement in principle to understand exactly what sort of lending you're going to be looking at, what net day one is coming in. That's what the bank are giving you day one. Most banks, most development lenders retain their interest then you basically you draw, let's say for example you're borrowing £1 million and the interest is 10%, so that's £100,000. The day one money you're going to get is £900,000. They deduct the interest cost. So that's an example of how. Just going through the examples on that sheet. So the 50% that we factor for tends to include the deposit. So that's the money that goes in to buy the asset that sits with the debt from the lender. 15% of the build costs, and you need this 15% because most lenders will fund 100% of the build costs, but you can only draw it down in arrears. So you have to spend 15% to draw down another 15%. They'll send a monitoring surveyor to site, which you pay for, and they do a survey and issue that to the lender to show that you spent the money on the site as you agreed, therefore you can draw down more. All of the purchase costs, what do I mean by that? All of the hard costs that you can't borrow against, so stamp duty, legals, whatever surveys you've got up to date to get that acquired, it tends to be a fairly good chunk of capital that you need to fund. Some bigger sites, the stamp duty is huge, so make sure you've got that factored for as cash and investment to get the deal over the line. Then we would always advise having a buffer and a contingency to do exactly what I mentioned at the beginning, to make sure that when you do get a down valuation or the monitoring surveyor thinks that your build costs are too low and they need to hike that up, what you then end up doing is getting a set of terms day one. By the time you actually go to do the deal, you're borrowing slightly less because they've lost confidence in your build or whatever it may be. And that's what banks do. They're always erring on the side of caution. So have a buffer in there as well. But that's our sort of general tip, a rule of thumb. Every deal is different, so don't take that verbatim, but just to get you off the ground and start doing your deal analyzer, 50% is a good rule of thumb.
What would you say in terms of loan to cost most lenders are currently looking for at the moment? Is it like 80%, like max?
Yeah, so loan to cost, you're at about 80%. We've done deals at 85% before. Loan to GDV tends to be around 60, 65%, and then loan to value tends to be 70 to 75%. Just to indicate how important these figures are, if you're buying a site for significantly less than what it's worth, I hear the catchphrase BMV, but if you're buying a site, for an example, for 400 grand less than it's worth because there's planning in place, your loan to value will be at 60%, but your loan to cost is 100% if you try and borrow all of that purchase price. So that's why they have all these metrics, and you'll find you'll hit ceilings on all three metrics and have to stay under all metrics at all times. And that's why it makes our life difficult. And that's why you need to know how much you need to put in to make sure you've got a blend of getting the right cash in place first, so you don't hit any of these thresholds and have to find another 30 grand later down the line.
If you're listening and are thinking, what are we talking about? I actually think it would be worthwhile us going into a bit more detail next week, maybe on loan to cost, loan to value, loan to GDV, and maybe giving a real world example of one of our projects and how the terms that we expected to get have differed between like what we were offered and what we ended up with.
Sure.
I think that'd be quite useful.
And any questions on that between now and next week, we'll integrate into that presentation.
Cool, good. I wanted to have a quick chat about CGIs because it's something that people are doing more so nowadays, which is absolutely brilliant. And it's great to see that people are using them to their best advantage to sell faster, get people through the door, and present your development in the best light possible. And even a lot of the time kind of give some brand identity to your scheme and give it more equity because of that. It increases the value of your site because of that brand. And I just wanted to talk about the typical process because people see the flashy images at the tail end and the finished article, but don't really know what goes on behind to go from, well, I've got this drawing, I've got my architect have designed this scheme. How do I go from drawing to amazing CGI that's selling my site and looks fantastic and is photorealistic and brilliant. So I wanted to just talk through that process. So you can see on the left-hand side here, we've got essentially a grayscale model. So I tend to ask for some of these to pick and choose the viewing angles and the views that I want them to create. It's no good saying, I want this render, I want it around about here and just get it back to me. I want it to be perfect, because that's just not going to happen. What's going to come back is something that isn't quite what you wanted. The time spent in rendering is the time from clicking go on the photorealism and the actual render, like graphic CPU kind of GPU process, which is very time consuming to do all of the rendering itself. So you want to do as much as you can in grayscale, with like flat imagery, like no rendering, as much as possible up front, to make sure that you spend, or the people that are doing it for you are spending as little time as possible on the actual rendering process. And when they do finally click that button to do a final render, it looks perfect. So we start off with a grayscale model. We do one round of comments. That goes back to the CGI artist. They generally send back a first draft with a bit of material, a bit of coloration, a bit like this image on the right-hand side. That's in which the time that I will make further comments on how I want to improve the look and feel of it. So you can't see all of the text on the screen, but I've mentioned things like there's fascia boards that are missing. I want round railings at the top. There's a timber gate missing. Bring it to life by putting in some people. I want a bit more color in that hedging. It's just very green. I want a bit of red in there, maybe a bit of yellow, just to spruce it up a bit. And that's the point in which they would do, you'd give your round 2 comments. They'll typically send through a second draft after that, which will almost be right, but I guarantee you it will just need one final check through. And then after that, they'll send you the final CGI, and hopefully it looks amazing and really helps to sell your assets faster. I've put the Bluebeam logo on the screen because Bluebeam is what I've made all of those scribbles and notations on. It's a CAD software, costs about £300 a year, I think, but I couldn't live without it. I think I've spoken about it before. It is something I use day in, day out, and would feel lost without being able to edit PDFs, annotate PDFs, cut and crop things, merge PDFs together and just manipulate it, draw on them, sketch on them, to share information really quickly, really cohesively to my team and external consultants. So would highly recommend Bluebeam, and that's just a bit of insight to get people using CGIs and discussing the process that we go through to kind of get those CGIs as best as they can be. Cool.
On to completion delays, but for good reason. We're sometimes slow in transactions, but on this occasion, that is not the reason. So this deal that you can see in front, which I hope you've seen from previous episodes of the podcast, is it's Colney Hatch Lane conversion of 2 10-bed HMOs to 9 luxury apartments just outside London. We achieved planning for 9 units. We exchanged on this particular site unconditionally. But the caveat that we had in the contract is we had a delayed completion of 12 months. What that meant is we could get the planning underway and get the site consented before we actually needed to complete. So that's exactly what we did. So we exchanged on this particular property for £25,000. We're buying it for 2.35 million. We then were running up the clock for 12 months delayed, and the owner of this asset actually specifically wanted a delayed completion to suit their personal circumstances. They live abroad, and I think there were some other moving factors. So it benefited all parties to create a win-win situation, and the timing was right for all of us because we could de-risk the site. Come around 12 months, and the vendor wanted an extension because they weren't quite where they needed to be to get the completion done. So we agreed another extension. And as of last week, we agreed another 6-week extension because the vendor would like to live in one of the properties just before we complete. So what that meant is we would then have liabilities of someone that isn't the owner or a tenant of the property in the property. So to clean things up, we said, look, let's just push it back 6 weeks. Doesn't necessarily impact us. We've got a strong pipeline and a lot to be getting on with. I think we looked at our legal sheet, and there's like 16 items in our legal sheet at the moment. So there's a lot we need to be going on with over the next 6 weeks anyway. So it doesn't necessarily impact us, and that's the benefit of having quite a sound pipeline. And when you build that pipeline, don't be afraid of pushing schemes back so you can focus your time on ones that might need the attention sooner. And that's pretty much it on this particular site. But yeah, keep it, because hopefully 6 weeks time we'll complete. And we will be getting heavily underway with quite an extensive refurbishment, basement extension, conversion. And obviously you can see from the CGIs we're going to town on the design, so it should be a good fun one to be on site.
Yeah, nice. I just wanted to touch briefly on kind of relationship building, having open and frank conversations with your sellers, building a good relationship with them, keeping them appeased, keeping them abreast of your timelines, and having conversations to understand what really is it that they want. And that can often play into your favor like this. It gives us a bit of extra breathing room, like Jack says. But to understand, if we didn't have an open and frank conversation with the vendor, we would have been absolutely busting a gut to try and get this done on the completion day that we said we would. But we can now take a step back, take the foot off the gas a little bit, because we've had that conversation to move things a bit further down the line. So relationships are key. Fire eggs. We've been having an absolute nightmare, and if you're in the same boat as me, I want to know in the comments if you found yourself a good fire consultant. I want them. It's been an absolute nightmare. I was talking to one of our investors yesterday about the old Maltings project, and we went out to 12 fire consultants. Only 2 of them provided a quote. The rest said they were either too busy, effectively they were too busy. Only 2 out of the 12 actually gave us a quote to work on the project with us. And it seems to be a very common theme. If Jack and I were to set up another business, which I'm not saying we will, it would probably be in fire consultancy, because everyone is super busy since the tragic kind of Grenfell Towers project. And there's been a much tighter grip on fire regulations from building control, and everybody really, every fire authority are very, very, excuse the pun, but hot on fire regulations, to the point where 2 years ago there'd be a lot of pragmatism and good discussions about, well, it doesn't quite tick the box from a building regulations part C, clause 3, whatever, diagram F. But we've done a risk analysis and the risk is low. The outcome is low. Therefore, kind of we'll accept this, and from a building consultancy perspective, we'll sign it off and say that the risk is low enough that we can get it passed. Nowadays, everyone seems to be, no, if it doesn't tick that box, it doesn't tick the clause completely in regulations, we will not put our name behind it. We will not put our PI behind it. And therefore, you're going to have to change the design to suit what we are telling you to do. Building control, where previously they may have taken their own view on certain things, are very much pushing back towards if your fire consultant and your fire strategy doesn't say you can do this, and it's backed by their PI, then we are unwilling to accept it ourselves. So you've kind of got 3 people to appease. You have got the fire consultant that you're working with, who historically may have taken a view on certain things and now struggle to do so, as far as we found. You've got building control to then get through, and then building control also will send it out to the London Fire Brigade or your local fire authority for their input as well, who are sometimes even more stringent. So be aware, getting a fire consultant on board as early in your design process as possible is now fundamental. With the old Maltings, we have wasted time and money because this advice has come too late. Part of that was because I couldn't quite get my head around why no one was being pragmatic. And we went through, we had various conversations with these 12 consultants over the phone and a couple of video calls. And I couldn't really find that company that was willing to not bend the rules, but just be pragmatic about some of the solutions, until I realized that none of them are going to be pragmatic about it anymore, and they have to live by the rule book. So yes, just be aware, get fire consultants on board on your schemes as soon as possible, no matter how controversial or non-controversial it may seem. Cool. The next thing is all about speeding up your development finance. Like Jack says, we've worked on or purchased a scheme every 4 weeks over the last 5 years on average. A lot of paperwork, a lot of finance. And this is what I wanted to go through here. We were actually sent an amazing schedule, which is what you see on the screen, which you can't read, but if anyone's interested in getting this schedule, comment schedule below or email info@xbproperty.co.uk. And it is a list of all the things that your monitoring surveyor, which works on behalf of your bank, may need to review to give his valuation report or monitoring surveyor report to your bank before you start works. The more information you can give them as soon as possible, the less back and forth you're going to come up against, the less questions you're going to get through the process, and it's just going to speed up that whole bank process no end. And I'm just going to blitz through the list here, but if anyone does want this spreadsheet, comment below. So give them as much information as possible that you have on costs, so a cost analysis, cost breakdown, QS report, spec of works, whatever that may be. Details on the program, how long is it going to take, what are the key milestones, what are the statutory consents that you've got, do you have planning permission in place, are there any conditions that you need to discharge, building regulations, have you got your initial notice, which building regulatory body is working with you, have they done a plans check analysis, do you have any feedback from them, any section agreements, section 106, SIL payments, any section 278 works for highways works on your site, utilities information, have you already got quotes from utility bodies, has any of those started, have you done any ground investigations or structural investigations that will help speed things up and show you that you de-risked your development by understanding what the fabric of the building is doing or the foundations are doing, so you don't have to do that at a later date and find a shock or a surprise that you didn't expect. Contractual obligations, is this a JCT contract? What are the terms of that contract? Are there any contracted design portion elements like M&E? And all of that information, your architect's plans, your interior design information, insurances, so that may be your contractor all risk insurance, your architect's PI cover, your own public liability insurance, etc. And then who are the key parties? So who is your architect, structural engineer, and everyone from a consultancy basis working on your scheme? What warranties do you have in place? Who are they with and what are their terms? And then finally, your health and safety and your CDM regulations. Who is your principal designer? Who is your principal contractor? And this is all very, very neatly wrapped up in this monitoring surveyor spreadsheet, which you can go through and use as a checklist, saying, yes, I've got this. Here's the Google Drive link. No, this isn't applicable. We don't need this, and just basically use that as a checklist to really speed up the banking process.
Good. Shall I take this one on? So I don't know if anyone watching saw Ben's video. I'd highly recommend going over to his Instagram channel, but it's the real key driving force to us putting on an event, which is next Saturday. Our whole team, our group, I think there's about 14 of us all involved, are going to be taking 2 tandem kayaks from Abingdon, which is where we've got quite a lot of investment properties, HMOs, developments, etc., and kayaking all the way down the Thames to Henley-on-Thames, where our HQ is. For anyone out there, we think we might have actually overcooked what is possible. The average person should kayak about 15 to 20 miles a day, but if it wasn't a challenge, then why should you back us and donate? So we wanted to make sure that this really did challenge us. So we're setting off at the early doors, crack of dawn, and we're sort of tag teaming as we go. So there'll be two kayaks, 4 paddlers at any given time. We've got to overcome current, wind, weather, locks, who eats all the flapjacks in the boat. But we're super excited to get the whole team around us to raise some serious money for such a great cause. And it's a really close to home charity that we're going to be working with. So go and watch Ben's video if you haven't already. Just like to take this opportunity to thank everyone that's helped us already to get up to £3,500 in raising money for this charity. We've actually upped our target twice. So let's get to 5K and then maybe up it again. But if there's anyone out there that's kayaked for a day, I'd love to hear how far you've been, because we have no clue whether this is actually possible. We're just going to put our everything into it. But thank you very much, everyone that's already donated.
Yeah, thank you very much. So we've onboarded a new mentee this week, and I wanted to share the story of how that came about, because we get asked a lot, why do you do these lives? Why do you, post on social media? Like, what benefit do you see from it? And the proof is in these types of stories. So I actually worked with a client probably 3 years ago where we were looking at a South London hotel and redesigning some of the spaces with him, looking at loft conversions, looking at maybe turning the hotel into a cluster block of HMOs, or looking at ways in which we can increase the revenue and expand the space and then add value. And that was a great process. It was really good working with him. We did what we needed to on his project. But after that process, it didn't really sort of stop there, because he followed the journey of kind of what Jack and I were doing at XP Property, that we'd been building in Aura, and just keeping tabs on the goings and the things we've been up to, without really reaching out or getting in touch. And then probably 2 months ago, out of the blue, message saying, look, can I come to the Aura office and can we have a chat? Which I was obviously happy to do. So came in and effectively laid out kind of what he wanted to achieve over the next sort of 3 to 5 years in property. And he said, look, I've got a pool of cash available to me, and I want to start with a small amount X. But the reality is that over the next couple of years, there's assets that I can refinance, and that pool of funds will be far greater. And he's looking to invest either through somebody like us or with somebody like us. So that's the kind of reason why we post about what we're up to, while we kind of build relationships with people, share, and hopefully give education and information to the wider masses, because it attracts people like our mentee. So not only does he want to work with us from a joint venture perspective, but he also wants coaching to understand how he can use his funds to get to his goals and achieve what he wants to achieve in terms of revenue over the next 5 years. And we had our first session yesterday, which I think we all went out of it kind of in a completely different route to the way that we came into the conversation, but in a very good way, because it kind of didn't poo-poo some ideas, but it basically just made him think about really what is it that you want from the outcome in 5 years' time. And I think there was a lot of conversation about going up north for yield and talking about buying 24 properties in the next 2 years, effectively one every month. But as soon as I sort of said, what would you prefer to do? Either have basically every week you're looking at mortgage funding, paperwork, legals, back and forth with your solicitor, for literally the next 2 years of your life. Or would you rather do 2 bigger assets where you can go to site, you can see something coming together, you can buy well, you can add value yourself throughout the different stages of the build? And the outcome was, well, actually, I prefer not to be bogged down by the paperwork of legal process and buying, £200,000 up north in an area that I've no idea. I don't have anyone up there. It would be reliant on other people managing that process for me. I would rather be doing something that's an hour max from home, where I can go, with my family to see it coming together. There'll be capital appreciation and all those other good things that you get sort of typically down in the south. So although it wasn't necessarily the mindset coming into that conversation, by the time he'd left, I think he was in a much better place, really understanding what he wanted. And that's kind of what the coaching and the mentorship is about. It's kind of from our perspective, it's asking the difficult questions. What is it you really want from this? Is what you originally thought going to achieve that? And are there better ways of doing that? And can we help you achieve that by learning from some of the mistakes that we've made, and vicariously kind of learning through all of the things that we've done in the last sort of 5 or 6 years with our businesses. Anything you wanted to touch on that?
No, I think the north-south divide is something that we'd love to do a topic on, but we're already up to 40 minutes, so maybe that's a topic for another day.
Yeah.
On to the next news. So Fridays, solicitors are legally only allowed to exchange on Fridays. That is a lie, but they always end up happening on a Friday. But good news is we exchanged on House 2 in Sunset Court. It's good to get that underway, and the buyers have exchanged. So first of 6, we've technically under offer on 4. So hopefully there'll be more to come soon.
Yeah, it's always 4 o'clock on a Friday as well. It's never like in the morning. It's always last minute, last doors.
I reckon solicitors work Friday afternoon only.
Yeah.
Yeah.
I wanted to also say on this, they are moving their belongings in on Sunday, which we've allowed them to do. So we wanted to get them to exchange to allow them to move some of their belongings in. And then they are at hand to complete on notice, which effectively means when we give notice that the property and the site is fully ready for occupation, they have 7 days then to complete on the property. They want to move in as soon as possible. We're trying to move them in as soon as possible. Thames Water have been an absolute nightmare. They've pushed the installation of our final water connections back again. And we're trying to deal with that to wrap up the final bits on site. So as soon as that's happened, we can complete, but we need to get all these 4 exchanged as soon as possible to get them over the line and money in the bank. I think that's it, isn't it? Oh, just a big shout out to the Property Experts podcast. If you're listening on there already, absolutely brilliant. If you tune into our YouTube, but can't always join in at 5 o'clock, we are on Spotify, Apple Music, Castbox, Amazon Music, and all your normal standard podcast platforms. I've got the podcast editor in the background doing episodes 10 to 17 from these live exposés, and they will be launched over the next month over on all of those podcast platforms.
Very good. Well, thank you very much, everyone that joined again, and just another gratitude and thank you for everyone that has donated to the charitable cause already. We will share the link to the Just Giving page somewhere around this. So thank you very much for that. And we are going to do some sort of live tracking to show where we are. So if it's coming up to midnight and we're just outside Abingdon, feel sorry for us. But one thing we have got going for us is we are going downstream. So super excited to take that challenge on, and also a bit of team bonding. As well, because there's a lot of banter that flies around the office, and I'm looking forward to see what that looks like on the river when someone's fallen in.
Excellent. Thanks for all the donations, and see you again next week.